You're watching Masters in Trading Live with Jonathan Rose.
Hey everybody, it's Jonathan Rose and welcome to Masters in Trading. Today we're going to do something a little bit different. Today is going to be day 2 of our 3-day divergence classes. It's kind of funny. As a floor trader, we used to trade with our hands. You're not allowed to do that for 3. This was not being allowed to be used for 3. All floor traders, in order to use 3, you had to do this, like this. It's kind of weird. Took a little bit of adjusting. This is 3. Nobody would trade with you if you just did that. Kind of a weird thing. Nevertheless, today is our second day talking about divergences. If you didn't get a chance, guys, go back and watch that first video yesterday on divergences. I talked about what is a divergence. I talked about why we care about divergences. And I also walk you through my career because I want you to see that every single trade, every single stop throughout my career, we've always had some kind of a divergence trade. I've never just traded the NASDAQ and crossed my fingers and hope for it to go higher or bet for it to go lower. Instead, we look at the difference between the NASDAQ and the Russell. We look at the difference between the NASDAQ and the S&P. Everything needs to be tied down. So that's what I'm going to go over today. Today, I'm going to share my 5 favorite divergences. I'm going to go through a bunch of examples. This one may be a little bit longer than our usual Masters in Trading, but I think you're going to be okay with that. So with that being said, I got the chat up. Hey, everybody. Thanks again for joining. I got the chat up. Let's go to the screen and let's have some fun. All right, 5 divergences to watch. Don't worry, it won't be this overwhelming throughout. I'm just using this to start us off. I got my pen. This, guys, is a correlation matrix. Correlation matrix. Okay? Now, we're not going to look at this whole matrix. We're going to look at just a piece of it. And right now, we're just going to look at the energy side of the correlation matrix. Now, crude oil and Brent. Crude oil is oil that comes from West Texas. Brent is oil that comes from the Oman Sea. So Brent and crude oil are perfectly correlated. When something has a correlation of 1, they are the exact same thing. When something has a correlation of 0.99, they are the exact same thing. So let me show you this because I need to build the foundation of exactly what a divergence is. Because I charted Brent oil out of Oman. You could think of this as European oil versus crude oil out of West Texas. Here's what it looks like going back 3 years. There's 2 different products in there. They are moving lockstep. These are perfectly correlated. When we have something that's perfectly correlated, you can't do a divergence trade. But if Brent traded 10% higher and WTI traded 10% lower, don't you think inevitably they're going to come back to trading the exact same? Yeah, because their correlation is 0.99. It's a correlation of 1. So when we look for trades, we don't want a correlation of 1. That's ridiculous. Instead, we want correlations closer to a chart between crude oil, crude, gasoline, and heating oil. This is heating oil. Now look at them. They're not all moving together, are they? But instead, once in a while, they're going to break apart. And when they break apart, throughout my career, this is how pros trade. You want to buy what's cheap, and if anything, you want to sell what's expensive. And these three have a correlation of 0.85. That's going to be a much better tradable relationship. So overall, we want stocks, commodities that know each other, but we don't want them to be the exact same thing. So let's start. Now that I've set that up, guys, here are 5 favorite divergences that I love to trade, that we look at all the time. One is going to be something called the crack spread. I'll explain exactly what that is. It's a weird term. Are you guys familiar with the crack spread? Can I get a Y or an N in the chat? I'm going to explain it as well, but as I'm going through this, a Y if you know what the crack spread is, an N if you don't know what the crack spread is. We're going to look at the metals complex. We'll look at solar stocks. We're going to look at natural gas stocks, and then Brazil, China. I'm getting lots and lots of yeses. Let me explain the crack spread. And I'm going to do it with a little visual. The crack spread is literally the profit margin for the entire refinery industry. The crack spread is the profit margin for the refinery stocks. So once you figure out how to do the crack spread's a formula. It's 3 oil, 2 RBOB, 2 RBOB gasoline, and 1 heating oil. But wherever the crack spread goes, all those little refinery stocks are going to follow. And I love this image because it shows it perfectly. This trade is one of our bread and butters that we do all the time. So here is the crack spread. The crack spread is right here. I labeled it in yellow. It's right here. I'm going to put red over it. Now, most important, the crack spread is Mama Duck. Wherever Mama Duck goes, all those little refineries follow. It is a phenomenal trade, and it's a trade that I've been doing since probably, since 2005, I would say. Take a step back. Wherever Mama Duck goes, that crack spread, all of these follow. You notice down here, you notice this purple line? This purple line was really dragging when Mama Duck crack spread was rallying. I took everything off and I just kept that purple line, because look at that purple line, still getting whooped while the crack spread is rallying. These are some of the most high probability trades that I've ever traded in the entire market. Again, the crack spread is literally the profit margin for oil refinery. It's like watching the profit margin for Apple. We can't do that, but if we could, we would death stare that profit margin to trade Apple. Well, that's what we did with Dyno. Dyno is this purple one right here. Here are our Dyno trades. We got into Dyno March 19th. A little bit early, right? Then we got into it April 1st, grabbing the low. Then we get into it 522. Still trading this. Why? Because the crack spread is so unbelievably strong. Keep things simple. If the crack spread is showing the profit margin for refiners, we want to find the cheapest refiners that we can potentially do. That is one of our favorite trades, the crack spread. Let's move on to trade number 2. First, crack spread profit margin for refiners. Next, let's look at the metals complex. Again, I'm going to pull this up. I want you to hang with me to the end, guys. I'm going to show you exactly how to do this. Dick, that is funny. The crack spread because I showed ducks. Dick said the quack spread. Dick, you and I would be friends. That's my kind of humor, my friend. Let's look at the metals complex. Metals complex we're going to look at over here. And I'm going to look at platinum, silver, steel, probably not. We want to look more of like gold, copper, okay? I'm going to show you exactly how to do this as well, guys. So metals complex. Let me get my pen back. Where did my pen just go? We look at the metals complex, copper, platinum, silver, inflation. Hard assets get more expensive. What trades have we been looking at? Those who have been in the community, we are getting long platinum. We are getting long silver. We are getting long copper. Why? Because gold is taking out its highs. And they're all correlated. They're all playing catch up. I want to share a trade that we did in the metals complex. This is gold. This is platinum. Platinum and gold correlated. But in 2024, gold, super strong. Why the heck didn't platinum follow through? I'm going to share all this information. I'm going to show you exactly where to find this information. I want you to hang with me though. I want to go through my 5 favorite divergences, and then I'm going to show you the exact sites to get all this information for free. So platinum, we did gold, we sold some gold, and we got long platinum. Pretty straightforward trade. And if you look at the chart after the fact, I find that whenever I'm teaching, and now we look at the chart, it looks pretty easy, right? It looks pretty easy with gold going straight up. Platinum has historically been correlated with gold. It makes pretty much sense. Oh, get long platinum. These are trades that I want you to learn, that I want you to do. When you get long platinum, you don't get long platinum because of a head and shoulders or some stupid breakout or Fibonacci or Gann. You don't need that. Divergences. If we know the metals complex is super strong, what's the weakest part of the metals complex? That was platinum in this example. Crack spread. Metals complex. Solar stocks. Solar stocks are moving a ton right now. Why? Well, there's the big beautiful bill. They're not going to have solar in there, subsidies. Then they're going to put the subsidies back in. So what do we get? We get volatility, but we're getting volatility in the solar sector. Within that solar sector, you can peel back the onion, I think it's called, and look under the hood. And under the hood, we want to look at different solar stocks. FSLR, JKS, Run. 3 solar stocks moving together as an industry. Run is a name that we were buying when it comes off. Why did it come off? Because there's news bombs all over the place. But when solar is still holding up and just Run sells off, that is a potential for a trade. Traders could sell one and buy the other, or you could just buy one. So overall, when we're looking for these divergence trades, you want to find industries that move together. Natty gas. This yellow line is natural gas. That yellow line is the natural gas futures. Now, whatever the futures are doing, the natural gas stocks are going to follow. So that yellow is natural gas futures above CRK and EQT are natural gas stocks. What's going to happen when one natural gas stocks goes parabolic while the other one doesn't move? They come back. Remember, we're trading a sector. You're not trading individual stocks within that sector. Finally, one we like a lot. I love trading these Brazil stocks. China is a huge investor in Brazil. Right now, with all the tariff talk, there's lots of volatility in these Brazil names. They are all correlated. When they break apart, sell what's expensive and buy what's inexpensive. Look at all these trades, guys. Sell what's expensive, buy what's inexpensive. Right now, EWZ is stupidly cheap relative to iTub. In our third day of our divergence class tomorrow, I'm going to be sharing a trade with you. EWZ and iTub is certainly a trade that I'm going to consider. I'm going to look into it. I think I'm going to find something even better for you. But tomorrow, on day 3, I'm going to share my favorite divergence trade right now. These are just more crack spread trades, VLO and CVX. So here they are, guys. Here are the 5 divergences to watch. Crack spread, metals complex. We have solar, natural gas, Brazil, China. What I want to do now is I'm going to show you exactly how to find this information. Let me open up a new window. This site is fantastic. I am not affiliated with this site at all. For those who are not working with us, I want you to be able to get this information for yourself. So here you go. Again, I'm not affiliated with these guys at all. It's just a site that I like to use. Trading economics. Markets. Commodities. I'll put this in the chat for you guys. So look what they did here. This is fantastic. You go to this site, correlations, bang that correlation, and then you have a phenomenal correlation matrix. 30 days, 90 days, 180 days. Play around, go to 30 days. Look at the energy complex, the metals complex, the ags complex. No, I don't want your notifications. If we go to the energy complex, find trades, be creative. Heating oil, gasoline, heating oil, crude oil. Stay away from natural gas against heating oil. It's only a 0.41 correlation. Okay? Find cool trades. Uranium. Uranium down here, uranium's only correlated to ethanol. I don't know about that. Be creative. Find cool trades. In order to do this, I'm going to give you one more little lesson here. You guys still with me? This making sense? I'll do this example in Thinkorswim, but you can do this example in any trading platform that you have. PAS is a silver company. If I hit the beaker here, if I go to comparison, add selected. Now, if I look at this against a gold miner, GDX or GDXJ, Okay. Apply. Okay. That's how you can do this. GDX is a gold miner. PAS is a silver company. Change the years. Look at the correlations. Adam, hey bud, does the negative mean they move opposite? Are you talking about on that trading economics here? Yeah, it's a negative. That's a negative correlation. They move opposite. All I want you to consider, guys, are the names in green. If you're not a 0.75 or higher, I would take a big fat pass, but play around with this trading economics site. It's a valuable tool in order to find free correlations. Okay, guys, this was a lot of fun. This was day 2, my 5 favorite divergences. Now what I'm going to do is I'm going to spend the day going over those 5 divergences because I'm going to research a wing dinger of a trade for you. And I'm going to share that trade tomorrow live in our 3rd day, not third, in our 3rd day of divergence trading. Smash that like button, Salt. Thank you. Subscribe. Thanks for watching. We'll see you guys on the inside. I'll see you guys tomorrow. Thanks for watching. Hey guys, how we doing? Sorry, I'm just pulling up my Discord on my other computer.